This is Matthew Cratter from Trader University, and today I want to talk about how the Fed is in big trouble. The chairman of the Fed, Jerome Powell, really the chief wizard of the U.S. economy, has begun to do something that I want to alert everyone to, because I do think we're entering the end game here in terms of money printing and what's called yield curve control. So if we take a look at the Fed minutes from January, these were just released a couple weeks ago. There's a delay on these, and so these are the minutes from the meeting. And in this, they talk about how they're going to continue to buy Treasury securities, $80 billion worth of them per month, and mortgage-backed securities, about $40 billion per month. So about $120 billion per month of securities. And the way they buy these is they just make money out of thin air using the money printers. So this was the date of this meeting was January 27th. 2021. Now, if we look ahead and see what they actually ended up buying, they took the Fed balance sheet, which is all these securities that they hold at the Fed, mostly treasuries and mortgage backs. They took that up from 7.404 trillion to 7.59 trillion. So what they basically said in the minutes is that they're going to grow the balance sheet by 120 billion. Instead, they grew it by more than 50%. 50% more than that. The balance sheet grew by 186 billion. Again, this is just a couple monthly data points, but if we look at what was happening in the background, we'll understand why they were forced to do this. But before I talk about that, if you're enjoying this video and finding it useful, I'd ask you to hit that subscribe and like button. So while the Fed was growing its balance sheet by 50% more than it said it was going to do, the yield on the 10-year note treasury, this is a chart of it. The yield went from approximately, call it 1%, 1% on January 27th, which is roughly when that meeting was, and it spiked above 1.5%. Today we're at about 1.67%. So the Fed is very worried about this spike up in yields. They've already said that they're going to let inflation run hot, and and the bond market seems to be trying to call their bluff and moving yields higher, because if inflation's going to be higher, you need to demand a higher yield on your bonds. Otherwise, you're losing money. Now, central bankers have a long history of lying about things. This is an article about the ECB, the European Central Bank, and it's really funny because the title says the ECB plans to ramp up bond buying to hold yields down. Basically, if you buy bonds, you buy a lot of bonds, you can keep the yields low or drive them lower. This is the takeaway from the article, and yet if we look at the quote from Christine Lagarde in the article, she says we're not doing yield curve. We're not doing yield curve control. In spite of that, the Fed, the title of the article, here it is, we're not doing yield curve control, ECB President Christine Lagarde said. In spite of that, the title of the article says they are doing yield curve control. Now, all of these central banks are in a very bad spot, as we said. We can see it right here just in this breaking news. Everything depends on what these central bankers do in terms of equity prices. This breaking news at the top here, S&P 500 falls, led by tech shares before an update from the Fed. No one cares about tech earnings. No one cares about fundamentals anymore. We're really in clown world where everything is a function of interest rates. And when you have very low interest rates, any move in them can have a catastrophic effect. The moves are much more exaggerated due to convexity when you're dealing with very low yields. And so what these central bankers are going to need to do, they're going to need to cap yields for a number of reasons. But in the process, they're not going to admit it. So Christine Lagarde's going to buy bonds and say we're not doing yield curve control. In the same way, in the fourth quarter of 2019, the Fed started regrowing its balance sheet and pretended that it was not doing money printing and quantitative easing. But in the process, they grew their balance sheet from, call it 2 or 3 trillion all the way up to 7 trillion, where it is today. So you can't take these people at their word, and there's a good reason for that, because if they start to talk about what they're doing, it can cause a huge problem. So instead, we get lots of tea leaf reading that, and so you actually have articles like this where you're looking at Fed governors and they say that the move up in yields caught their eye. It's a sort of tea leaf reading that everyone's been reduced to because we have this terrible institution at the center of our economy, the Federal Reserve. Now, yield curve control is basically already here. They need to cap rates roughly where they are now. If they don't, stocks and real estate will fall, and most importantly, the U.S. government will be unable to service its debt. The U.S. government cannot stand to have interest rates go back up to 3 or 4% on the 10-year note, where they were not too long ago, even 5 years ago. But the problem is, if you tell everyone that you're doing yield curve control, and you also tell everyone that you're willing to let CPI inflation run above 2%, run a bit hot. We know the CPI is a big lie. Real inflation for most people is really running somewhere between 8 and 20% a year. This is the rate at which everything you want to buy, like a house, like school tuition, medical costs, this is the real rate that things are going up. Either way, the yields on these bonds do not compensate, not even for CPI inflation, which is roughly their target is to let it run a little hot above 2%. So if you announce to the market, if you're the Fed and you announce to the market that you're doing yield curve control while letting inflation run hot, everyone is going to dump their treasuries on the margins. And what will happen then is that the Fed is the buyer of last resort. And so they will need to buy all of these treasuries. And this will mean that the Fed's balance sheet will have to go from about $7.5 trillion to 10 trillion to 20 trillion to 50 trillion as it increasingly takes onto its balance sheet all of the U.S. debt that's generated by deficit spending. And so this creates a problem every time the U.S. government ramps up stimulus, does another stimulus package. They'll have to issue, the Treasury will have to issue more debt, the Fed will have to buy it, etc. And so this is why they can't talk about it, but why there is a crisis now. And this is probably why they're growing their balance sheet faster than they said they were going to, because this drive up in yields, you can only imagine as Treasury yields are breaking higher this morning, the Fed is definitely going to need to step in. And the reason we know they're going to need to step in is the stock market lets us know. When stocks start to fall, then everyone panics and the Fed has to come back in and control yields. Now, yield curve control is coming. It's a necessity because otherwise the U.S. government will go bankrupt. And so the Fed is, I would suggest that we're already in crisis mode with the Fed. They are doing yield curve control, YCC, as we speak. This is very bullish for stocks. It's very bullish for real estate. It's very bullish for Bitcoin. One would think it would be bullish for gold as well, though gold has been really struggling. But the real honest thermometer in the room that tells you that the temperature is rising is Bitcoin. This is an unmanipulated market. It's not like CPI inflation. It's not like gold, which is hugely suppressed by the government selling huge amounts of paper gold, etc. This is the real truth serum, or the real thermometer in the room that really tells you that the room is overheating and that we have true inflation, which is the result of the U.S. dollar being devalued by too much money printing. So this is what's happening. The Fed cannot admit it, but what this means is that the Fed will have to continue to buy bonds, probably at an accelerating rate, as we've been seeing here, especially if President Biden wants to push through another stimulus package. This is it's hard to say how bullish this is for Bitcoin. It will continue to drive it higher and higher. Tomorrow, I'd like to talk about Ray Dalio's paper. A lot of you have mentioned it to me. This is a very important paper, and it talks about some of the same things we've been talking about today, interest rates and yield curve control. So stay tuned for that. Hope to cover that tomorrow. If you found this video helpful, be sure to hit the subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.